crude oil prices, repeated petrol and diesel price hikes, and concerns over a weaker monsoon could actually push inflation higher in the coming months. While most economists are actually not expecting a rate hike this week, several of them believe that the RBI's next move could eventually be higher rates. And some actually expect a cumulative rate hike of 50 basis points in FY27 itself, with the first increase potentially coming in as early as October. That's why the bigger focus on Friday may not be the rate decision itself, but the RBI's message. Markets will keenly watch whether the central bank turns more hawkish, raises its inflation forecast, or cut its growth outlook. Many economists expect the CPI inflation projections to move closer to 5% from 4.6% earlier, while GDP growth estimates could be trimmed down to 6.5% from 6.9% for FY27. Now, the RBI may also hint at other measures to support the currency, such as encouraging capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring action, but it could bring a strong warning about what's coming next. Stay tuned to Live Mint for more such updates. Capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring action, but it could bring a strong warning about what's coming next.
Business never stops.
Stay tuned to Live Mint for more such updates. Capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring action, but it could bring a strong warning about what's coming next. Stay tuned to Live Mint for more such updates. Capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring action, but it could bring a strong warning about what's coming next. Stay tuned to Live Mint for more such updates. Capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring action, but it could bring a strong warning about what's coming next. Stay tuned to Live Mint for more such updates. Capital flows or easing overseas borrowing norms instead of raising rates. Friday's policy may not bring.
A temporary ceasefire was announced today, and the disruption in global supply chains. Before the outbreak of the West Asia conflict, India's macroeconomic fundamentals exuded confidence with buoyant growth and low inflation. Conditions, however, turned adverse in March with the widening of the conflict zone and its intensification. The fundamentals of the Indian economy are on a stronger footing at the current juncture than it was in previous crisis episodes, as well as relative to many other economies, providing it with greater resilience to withstand shocks. Global growth faces increasing downside risks as the sharp rise in energy prices and shortages, some of which we saw a correction today in the prices of energy, and shortages of inputs for various industries have stoked inflation fears and pushed up the geopolitical risk premium in the oil markets. Heightened uncertainty precipitated by the ongoing conflict is weighing on the outlook. Safe haven flows have exerted depreciation pressure on currencies of major economies as the US dollar strengthened, while commodity prices such as of metal and gold have moderated. Financial markets have become more volatile. Equities registered a broad-based correction. Sovereign bond yields, already elevated due to long-run fiscal sustainability concerns, driven by inflation fears, have hardened across major economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on 6th, 7th, and briefly today in the morning of April to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged under the liquidity facility at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank